Okay, welcome here to Transaction Review and Calculator Practice for May 2015. Tonight, we have a privilege to review a deal that one of our members, Anthony Wheaton, has been working on. Okay, great. So, when we talked first last month, can you just sort of catch us up on the big story? Is this still the story? Your friend who's a real estate investor?
Yeah, so let me see here. His partner recently finished single family. Okay. Yeah, so basically this gentleman and a partner bought a house in the city of Santa Ana, and it was a tear down. So
Uh-huh.
they pretty much demolished the property, and they built a brand new one in its place. They replaced it with a two-story, 5-bedroom, 3-bath, 3,000 plus square foot home. And they designed it in such a way that it could really be used as a duplex. So there's a kitchen downstairs, and then they installed plumbing and electrical upstairs, so that if somebody bought it, they could easily install a kitchen upstairs as well. And there's also, I guess they designed there's a wall downstairs that could be a part of it that could be easily be removed, and another door could be installed there that would allow a separate entryway for the top unit. So ultimately, these guys are rehabbers, and I think I met this gentleman at a RIA meeting, and
Real
I got
estate
to know him a
investment.
little bit.
Just for those who might not know, it's a real estate investment club. So that's you get out and you're meeting the people that are active in the business when you're drumming up note business, right?
Yeah, right. So, kind of big part of our job as investors is to get out there and meet people all the time, and expose ourselves to opportunities.
Right.
So that's kind of how this came about. And anyway, I was talking to him initially about what he did. He told me, and then he told me that he had this project going on. So when he told me about it, I thought it was kind of interesting, because I saw an opportunity to maybe work with him by offering or helping him to offer some creative financing on his property in order to move it.
Right. So had
Um,
it been sort of sitting stagnant?
Yeah, it is. And as a quick update, that property, because he's not the sole decision maker in this deal, his partner was a little bit reluctant at first to go with this sort of creative sales strategy.
Right.
So, I mean, he was completely on board, but his partner was a little bit apprehensive about it, and consequently, she is the one that's on title. So, he needed her signature ultimately to sign my option agreement so that I could legally be within my right to market the property for him. So he told me that he wanted to give it a couple more weeks. They want to leave it on the market and see what they can do to try to maybe do it via conventional sale. So that's where we are. But I did put together uh, some numbers that I presented to him in terms of how the scenario would really kind of pencil out. So that's what I'm going to be presenting tonight.
But I think this is a good thing. I mean, so basically you're saying I want an option to buy the house for a certain price, and then you're just going to market it. You're not like, oh, I'm not your real estate agent. Um, I'm not. You just recording an option against the property. Is that how that works?
Yeah, so basically that was my intent. I did get my real estate license late last year in
Oh,
November.
yeah, that's right. That's right.
Yeah, I did decide to go ahead and do that for a lot of different reasons. But ultimately, I engaged him as a principal in the transaction, and I ultimately put together a option agreement that I was going to have him sign that would thereby give me an equitable interest in the property so that I could legally market the property. And then what I told him I would do, because it's actually currently on the MLS, but
Okay.
his brother is the listing agent. And he had basically, ran all of this by his brother, because I told him, I said, there's a couple of issues here now that I have a license, there's some ethics violations and things that could potentially be called into question. I said, so long as we're cooperating, I said, I don't want to do anything to step on his toes or jeopardize potential commission, whatever you guys have worked out. And he told me that that wouldn't be a problem at all. His brother was just trying to help, and that he was on board completely, and that they had the whole, compensation arrangement worked out between the two of them. So I said, okay, well, that's fine. So, I would just basically be optioning the property, marketing it. I said, but once those calls start coming in, I would like to, be interacting or engaging with these potential buyers directly, seeing as though I'm going to be the one kind of, dealing with the finance part of the equation.
Right.
So he agreed to that, because ultimately I was going to have those people be kind of funneled through my MLO and getting qualified regardless, because now with the new Dodd-Frank laws and whatnot, we have to use licensed MLOs to underwrite our borrowers to make sure that we are compliant with the new regulations from the
Well,
CFPB.
plus you want to be able to put together your buyers list. If not this property, what? Find them
Well, exactly.
enough.
Well, exactly. So that was the other piece, that I want the buyers list, right?
Right,
Because
right.
I want to go out there and do this again, and I want to already have a group of people with whom I can contact. So can everybody see my screen?
Yeah, I can
Can you
see you
see my
now.
screen?
I can see it.
Okay, so I put together this spreadsheet as really a tool for myself to be able to just kind of pencil out numbers really quickly. Um,
So let's
so
go over each one. This is great.
we'll go over each one. Okay, so essentially I, estimate that the property, it could be valued anywhere with, it could be valued really as close to 800,000. There are single-family homes on that same street that are selling for like 398. I saw a comp that was just I think a month or so ago, and the property was in tip-top condition. But of course, it's like really half the size. So there is one issue, with this deal that I didn't like, is the fact that they pretty much built this brand new neighborhood. I mean, this brand new property in a neighborhood where it seems to be the biggest property on the block.
That's exactly what
There
you don't want, is to have the nicest house on.
is to have the nicest house, right? So we know this, right? He is kind of, I guess he's an engineer by trade, but he's come over to the real estate investing space, and he also has other businesses, both domestic and internationally. And so, I kind of know this is like a cardinal sin, sort of, in the real estate
Right,
investment world.
right.
But he broke that rule, so I did make him aware of that on our first introduction. And and he told me, though, that there were other properties in the neighborhood that have recently sprouted up where people, this is kind of like becoming a trend. So it's partially true and it's partially not, that it's the biggest, nicest house in that neighborhood. But it certainly breaks the mold of what that neighborhood was originally. So just keep that in mind. So anyway, he told me that ultimately, bottom line, he needed to get, about 680 out of the property. So I just went ahead and said, okay, let's be conservative, and let's just assume that his asking price is going to be the property value. It could probably be valued more, but let's be conservative and just make those two equal.
Right. So you think
So
680 is a fair price, reasonable price?
I think that 680 is a fair and reasonable price, yes.
Okay.
Seeing as though, there are other houses in the neighborhood that are comping for, almost $400,000, and, they're like half the size of this property.
Gotcha.
And plus, this is brand new construction. These are the other ones are existing homes that
Right.
built in maybe the 50s and 60s. So I said, okay, so our seller finance price obviously is higher, because it's the financing is what's of greatest value in today's market.
So here's where you have
But
where it's 15% more.
yeah, so I have that percentage there as a markup. So that's assuming we can sell the property at a 15% premium. The seller finance price would be 782. And it's kind of like really the same discussion that people have when they talk about, the finance price versus the cash price, and and whatnot. So
Right.
the seller finance price typically is higher than the the same property that you have to go to the bank and get a loan for. So
Right.
um, in this particular case, 30%. Now that's very steep, but there are a couple of things to consider. One is that we thought that this property would either be really good for an investor who's looking for an income property and they want to come in and maybe buy a property that they could essentially use as a duplex. So they would then opt to install the kitchen upstairs and maybe the entrance downstairs so that they could actually get two families in there. Or the alternative was that we could get two families in there. In this particular neighborhood, it's a neighborhood in Santa Ana, and there's a heavy Hispanic population there, and it's not at all uncommon in these type of neighborhoods for multiple families to occupy a dwelling. Sometimes you'll have like parents, and then their younger kids will maybe be newlyweds, and they have a young family, and so they'll have one unit, and the parents will have another unit. So this isn't uncommon. So we figured if two families were sort of combining resources, they could probably swing 30% down. I told him, I said, this is a little bit ambitious, so just keep that in mind. I would say certainly let's require 20% down, because
Right.
we definitely want to make sure that our borrowers are invested, have skin in the game, and that they're not going to just walk away from this thing if they get into a little bit of trouble financially. I said, but let's assume that what you want, let's assume that we can get 30% down. So that would obviously be $234,600. The balance is 547.4. Okay. Now when I mocked this up, I did two different scenarios. Okay. So this scenario that I'm going over is only for assuming that he's going to carry back a first trust deed. Okay, I also did a scenario where he would consider carrying back a second as well.
Right.
Okay, so obviously I just put in there the LTV would be 80.5%. The loan term would be 30 years.
Do you,
The interest
by,
rate.
by chance, Anthony, do you have a desktop calculator that you could bring up?
Not a financial calculator, just this
Okay.
thing,
Okay.
just this guy here, but it's not a financial calculator. I
Yeah.
don't have a Mac, so I don't have the desktop version.
Yeah. Okay. Yeah. I'll just go, when I get the screen back, I'll just go over these numbers just so people can, just get it clear in their mind how you're just whizzing around on these things. So,
Okay. Okay. Cool. So I assumed an 8% interest rate, because remember, the whole idea is for me to work with this guy to structure a marketable note that he could then realistically expect to sell either at closing or shortly thereafter, and really accept take the minimal amount of discount on that. That's my whole objective, is to
right.
basically make up for the discount that he's going to take on our end, because we still need to buy the note at a discount to get a yield that we're looking for. But at the same time, he has his mark that he needs to meet. So one of the ways that I offset that was by marking the property up, selling it at a premium, and that kind of offsets that a little bit. And you can see how the numbers pencil out as we go. So 8% was the interest rate. It's not interest only. And then the monthly payment is $4,016 on that note. Now, I put in there a balloon term of 60 months, okay, because ultimately for a note investor that I'm looking to bring on board for one of these things, I'm looking to get them cashed out in 5 years, okay?
Right.
And a lot of people are sort of apprehensive about putting balloon payments in notes now because of the Dodd-Frank stuff, but I'm just here to say that it is entirely possible. However, you need to use a licensed MLO that really understands these new Dodd-Frank laws and can help you navigate them.
Well,
There is a rule.
you're allowed to do one in a 12-month period, right? That can have a balloon.
Um, well, yeah, I mean, the main thing that needs to be determined is that the borrower has the reasonable ability to repay the loan.
Right.
Okay, that is that is basically the rule. So everybody's up in arms about all these Dodd-Frank, CFPB regulations and whatnot. And I mean, it's kind of funny to me, and it's kind of not. It's kind of not because, yeah, they sort of overregulated, and they've made, our lives as investors in the seller finance space a little bit more difficult than it once used to be. But on the other side of the coin, it's like, well, really, all of these rules were designed to cure a problem, and the problem was is that the banks and all the lending institutions were making loans to people that they really couldn't afford. And so really all these regulations are designed to do is to make sure that loans are being made to people that they can afford. So it's kind of funny to me that everybody's up in arms about it, because at the end of the day, ultimately, all we're trying to do is make sure that people can afford to actually pay a loan that they're given. So anyway, aside from that, balloons are possible. You just have to have the loan properly underwritten and make sure that the borrowers are qualified. And if they are, you can put them in the loan. So at 5 years, the balloon payment would be, or the outstanding principal balance of the note would be $523,000 plus. Okay, now that's relevant because as you come down,
Well,
now
hold
you would
on a second.
see,
When I'm throwing that in, I'm coming up with 520. We're off about
well, it's,
$3,000.
okay, well, yeah, let me put that, okay, because you're on the calculator. There is a caveat. So that's assuming it depends on exactly when you are calling it due. So I think this takes into account that they made the 60th payment, not that the loan is going to be due on the 60th payment. So basically they make the 60th payment, and then the following month they pay off the loan. And they have 30 days, but the loan accumulates interest for that 30 days. So it pushes that figure up a little bit higher than it should be. Again, it's definitely ballpark. So ultimately, it doesn't make a huge difference in terms of anything,
Right,
because
right.
if you just look at the amortization schedule, I think it comes out to like 520 otherwise, right? If you just scroll down to 60 payments.
Yeah, 524.
Yeah, assuming that the loan is actually due and payable all on the 60th payment, then it's like $520,000 or something like that.
Right.
Something
Okay.
like that, I think.
Anyway, I just not a big point. Just was curious because I want to redo the numbers on here. For
Yeah, no, well, this is calculator practice, so
right.
it's good that you brought up the point, because I was going to forget to mention that. So then down here now, this is where we actually come on and purchase the note. Okay, so assuming that we come in and we purchase it at 445, 400, the adjusted coupon on that should be 13% approximately.
Uh-huh.
And if we put in an acquisition fee,
Now you
you
call it.
can.
Wait,
Go
just a
ahead.
quick question. You're calling it an adjusted coupon. Do you just mean what the yield is? Is that how you're what?
Well, yeah, okay. So yeah, let's get into some jargon. It's just, you can call some people, that come from the institutional side of the business, that buy institutional notes, they'll call the interest rate the coupon. I used it sort of interchangeably. I should have just said adjusted interest rate,
Yeah, or
but it's the
yield,
same thing.
whatever. Yeah, okay. I was following your numbers there, but just thanks for commenting on that. I mean, I don't use that, and I don't, deal in the bank paper side of things either. So
Oh, that's fine. Yeah, that's a good point, though. I think I
okay,
am going to change it, though, and just call it an adjusted interest rate, because when you buy the note at a discount, the interest rate changes. Okay, so the investor yield changes, as all the callers probably already understand. So it adjusts. So anyway, if we buy it at the 445 discount, the adjusted interest rate of the note is actually 13. Okay, so if we're talking about investors' yields, then we'd be talking about a 13.3% yield approximately.
right.
Okay,
Hmm.
acquisition fee. Now this model took into account that I was going to go out and find a private money lender that was
Right.
going to be entering the deal, and I was considering potentially adding on an acquisition fee. Okay, I just
Right.
put in 20,000, but it doesn't have to be. It could be 5, 6, it could be 10. it really just depends on, where everybody wants to be on that. That's completely at your discretion. But ultimately, what's most important to the investor is where is their ITV going to be?
Yeah, their investment into value. How much protective equity is there if something goes sideways?
Right. So, regardless, that acquisition fee, there is a point in diminishing returns because you always have to be looking at these ratios
Right,
that
right.
investors are sensitive to. So, assuming that, we're still below 70% ITV, some investors, every investor has a different threshold. I believed I had an investor that would be willing to put up the money to do this deal, and as long as their ITV was sub 70, they would be okay with that.
Sure.
The cost of capital is just the interest rate that the investor is looking for. Okay, so 7% on that money, this would obviously probably fall into an IRA category, an investor who's looking to invest their IRA funds. It's more patient money. So, for example, if we're looking at investors, when you're looking at potential capital partners or private lenders, there's different type of people out there, and everybody has their own sort of niche. Pretty much most of the investors that invest with hard money lenders, they're used to 12% yields, 15% yields, with those type of transactions. But those type of transactions are typically like fix and flip projects. So these people are a lot more impatient. They're involved in what I call a velocity model. They're looking to turn their capital, maybe twice a year if they can, and get those yields. And so that type of investor wouldn't be as interested in this type of model. Now, some of those investors might be interested as a means of diversifying their portfolio and sort of spreading out their money into different things. They might allocate a certain amount of money for high growth opportunities, and they might allocate another portion of their portfolio for long-term stable returns, like this type of investment. Okay, and this is a 5-year investment cycle. So I get this question a lot. People are like, well, who would lend money at 7%? Well, you're assuming that people know and understand what we do. So if you go to a RIA meeting, for example, and all of these people, for the most part, are exposed to real estate investments, and they've kind of seen the whole gamut of things that are possible. Well, people that understand our business and know what's possible, yeah, they might look at 7% and sort of turn their nose up at it. But I talk to a lot of people all the time that don't know anything about our business, and this is all news to them, and
Right.
they're ecstatic if they can get a 7% return
Right.
on their money because they can't find anywhere to place their money and get these kind of yields right now.
Right. So you found, and so did I, we all come to this. If you're really going to be successful in this business, you have to develop your own private back pocket source of investors, and you have to cultivate them and educate them out of, the stock market or bank CDs. That's where it's really going to come because you're right. I mean, the people. I mean, I've had issues trying to get my people down as the margins have gotten tighter and there's more competition out there. Sometimes you know Heck, I came across this note. This lady, brought me a note and she says, I saw you on YouTube I'm under contract to sell to a company and I just want to get your opinion if you trust them, if you think this is a good deal or not. And I look at it, I go, oh my God, I said I couldn't even touch this number. They were buying a farm note at less than 7% yield. I can't even touch that because I got to pay my
Oh yeah,
investors, 8 or 9%. So I said,
right.
you should feel good all day long about this. You're only taking a $5,000 discount on your note, which is phenomenal. And you can go and reinvest that and make a lot more. So, yeah, it was so anyhow, it's hard to train your money down once they get used to a certain amount. And
Well, right.
but the people that have just been making 0 and 1%, if you can get them comfortable with the asset class, it's really a gold mine for everybody. So
Right. So that, to speak to that just a little bit, it's really important that when you're out there raising money, that you don't just throw around some of these numbers so freely. Okay. For one, you have to be careful whenever you're discussing yields with people for a
Right,
number of different reasons. But um, you also have to understand that people have certain preconceived notions about interest rates and the inherent risks that are associated with certain returns.
right.
Like some people might think that an 8% yield is just crazy. Like that's crazy risk because they don't really know of these opportunities that exist in the note investment
Yeah,
world and
that's a good
discounted
point.
paper.
That's a
And
good.
so they'll look at an 8% yield and they'll be like, well, I can't get that anywhere. Like a high growth fund, mutual fund or something like that is paying 12 to 15. So, and that comes with a lot of volatility oftentimes. But
Right,
my
right.
point is that it's simply that don't be afraid to, when you're raising money, ask an investor what they feel is a reasonable rate of return for the risks that they're taking and the amount of capital that they're deploying, and let them tell you,
Mm-hmm.
because you could be shooting yourself in the foot if you go out and just jump out and say, oh, I'll pay you 12% or 10%, or, and you also have to be thinking about how we make our money. We make our money on spreads. So
Right.
if you quote them 12%, but you're underwriting your investments to 12%, well, there's no room to make any money. So you always have to be thinking about this. But you'll be pleasantly surprised sometimes when you're talking with people that, would say, hey, look, it used to be a time when I could go buy a T-bond and make a 4% yield, and that was the safest investment anyone could have on it, and basically buying a U.S. Treasury note, or something
Right.
like that. But those don't even pay that anymore. So those same people would be like you. I would be ecstatic if I could make that 4% or 5%. Oh, wow. So, you just have to remember that, it depends on who you're in front of. So
Yeah, good point.
that number is completely relative.
So let's go back to this. We got to wrap up here in the next little bit because I like to keep these at a half hour or so. But
Okay.
so now people looking at this number, they can say, look, if he would have just sold this note and made 20,000, is that a bad deal for Anthony? Does Anthony think 20,000 is a good deal or a bad deal? Like if you just flip this out.
I think that it's a great deal, quite
Yeah,
frankly. I mean,
like
for the
so.
amount of work that I've actually invested in this thing, yeah, I've put in some time and effort. I drove out to, meet with the investor. I've, kind of visited the property. I've done, quite a few things. But at the end of the day, if you look at all the time I've invested in this deal, if I could make that, that would be a grand slam.
To me it's not unrealistic because here, like if you got somebody, and this is even a seasoned investor would take this, because if you just sold it for 20,000, had like a buyer's, right, the note buyer's going to pay your fee basically.
Yeah.
You could look at it like that. You got the note for 445, he's going to pay 465. That would give him more than a 12% yield. That's the seasoned investor money. So if the rest of the numbers are reasonable, then you should at the least just make a $20,000 broker fee. Now, if you do the extra work, you did another job, you put on another hat, and that's my raising capital hat. So if you were, instead of giving someone a 12% yield, if you could find someone who will take 7%, right? Like you have here, then you not only make your 20,000, but you're keeping a piece of the cash flow and also capturing some of that yield spread so that I'm this back. So I think it's kind of hard. I really wish you had your calculator up there. So I'm going to take it
Yeah.
back. Just try to recapture this. Is that okay? Because I just want to see if we can
Yeah.
recreate your
Go
number.
for it.
Um,
Okay.
let's see. Me. This is really great. I'm really happy for you and good for you. Uh,
Oh, well, thank you. I mean, you can, you can congratulate me when I've cashed the check, but
no,
right now, it's a great idea. There's definitely potential there, and I'm hoping that this one pans out.
Well, if you're in motion and you can feel it and you can crunch it, it's already there. It's just a matter of time before it lines up. Because if you can feel it in your bones that it's real easy to cash this check. If not this one, one before too long. I mean, if you're a vibrational match to it, it has to show up in your world. I mean, there's no there's
Yeah,
no
well, no,
other
I
way,
hear you about that. It's
right?
true. I
Okay, so.
certainly feel it. Yeah.
Yeah, so and you've paid your dues. You keep paying your dues. So gotta hand it to you. So let's just recreate this. I'm gonna clear this. And sorry if I don't remember because I don't see your screen anymore. But we have
I'll give you the numbers.
okay. We had a
You
six.
want to?
This is what you think the property is worth, and we're gonna
Yeah.
add times 1.15. Well, you're at a 15% premium. You're going to say this is going to be the sales price, but with terms, correct?
Correct.
Okay, so 782. Then we take that number, and we say 30% down, but that means a 70% LTV note, right?
Well,
Is that the note?
it'll actually probably be. I think it actually gets to 80, close to 80, because remember we marked the property up.
Well, I
Even
mean,
though you're,
I'm sorry, just not on the real value, but on the premium value. So is this the note
yeah.
5474?
Let me see. Sorry. Yes.
Okay, and then 8% amortized over 360. That gives us our monthly payment. And then you have, since there's a balloon in after 60 payments, I'm going to calculate for future value. That's where we come up with that number. And you had a little bit different thing, but just for these,
Right.
let's leave it there because that's the most usual way to do it, I think,
Okay.
at least in my world. And
Yeah, I agree. I agree.
But anyway, so then you're saying I can buy the note for 445, 400, and if I do that, right, like table simultaneous close, table funding, my yield or my coupon, you got 1332, but the point
Yeah, it's
is
close enough.
sometimes
Yeah.
calculators are a teeny bit off. They do make some minor adjustments that are different depending on the settings and everything like that. But I don't be too
Yeah.
concerned here. I think I just want people to follow what Anthony's done here. So then he's saying, okay, I can bring some. I want to make at least 20,000 bucks. So I'm going to bring in someone who's going to pay. Let me recall this number. 20,000 more for it than I have it under contract for. And if he just sold it and got out of the way, that investor, is making a 12% return. Now that's your hard money guys that are used to those numbers. They like it, right? And then we got to look at, but are they still safe enough? So if we recall this number and we divide it by the real value of the house, cash value of the house, then we can see here, he's saying that he's got guys that as long as it's below 70 cents on the dollar, loan to value, they're okay. So we can see that he's still okay there. So he's reverse engineered that. But if he can keep a piece, if he can find someone who can bring 465.4 to the table and he can get them to make a loan, it's like hypothecating the note, right? Making a loan that's secured by, and I'm sure you'll assign it to them too, to protect them, worst case scenario, right? If you get hit by a
Yeah, I have a couple of different ideas about it. I was thinking about possibly putting it in a trust and making them one of the beneficiaries of the trust. So yeah, I had a couple of different ideas.
yeah,
Yeah.
I like that. Well, there's different ways, and I like that trust thing too. But if he can find someone that's good at, is this going to be just a balloon in and out?
Say again.
Like, is this interest only to them?
Yeah, it would be interest only to them.
Okay, so basically their balloon will be that, right?
Their balloon is what they have invested in it.
Right. So all they need to get a 7% return is 2714. So that's why now if he can add, now you've got like three hats. You've got the marketing hat, like kind of like the realtor hat to find the market and find the buyer,
Yeah, it's true.
right?
Yeah,
And then then if you find the note buyer, that's a good enough thing. But third, if you actually cultivate new capital that's never done this before, look at how much he's going to make. So his cut on each monthly payment is that is $1,300 of passive income out of thin air. Not that he hasn't put in all of his blood, sweat, and tears, but I'm just saying, right? So
yeah,
so that's great. And so and your back end here is the balloon we said was five something. I can't remember what that number was now.
yeah. It's like 520. Let's
So
just say.
when the balloon pays off for the end buyer, it's $58,000 higher than this, right? This number here.
Correct.
And
Yeah,
that's where you can really make out, right? So did I
yeah.
capture basically the deal?
Yes, you did. You did.
Great. So
Good summary. Wow, she's really good at this, guys. Pay attention.
well,
She's
Anthony,
been in the game a while though, so she should be.
oh gosh. Well, this is great. To me, it's a realistic thing. So before we get off, so when will you know if they're gonna give you a shot at it or what?
I think I'm going to give him the rest of this week, and then I think we're about at 2 weeks, and I'll probably follow up with him early next week to see if he wants to go ahead and option this thing to me.
And that's great. And I think that's the most powerful way is to engage as a principal, even though you have your license. So kudos to you, and thank you so much for spending your time to share this with us. And
Oh, you're welcome. You're
I really
welcome.
appreciate it. And if can I put your information on the blog once this is posted? If people want to contact you, do you want to engage?
Yeah, yeah, that's fine. That's fine. I
Okay,
mean, we're all here to help, guys. I mean, look, if everybody had everything that they needed in this business, then there wouldn't be partnerships, there wouldn't be joint ventures. Everybody would be a little island operating on their own. But that's not the case, you
nope,
know? So, if anybody out there is listening to this call and you guys think that you might know such an investor that would be willing to maybe lend on this type of note, please feel free to reach out because let me tell you, people may make verbal commitments, but until they actually give you that check, it's always nice to have a couple of
yeah,
backups
you
as
know,
well. And I would be more than happy to joint venture with somebody on this deal if they're interested.
yeah, I probably know someone who, if you could structure it where the ITV is a bit lower,
Uh huh.
where they're willing to carry back a second, you know, if we could get it below 60 or below, I probably know someone who would, I don't know, 7 or 8 they might do, and they're local in LA. And
Okay. Well, Don, you always get the first right of refusal,
well,
right?
yeah, just
Right.
well, no, I don't need that, and thank you, I appreciate it. But if that something goes wrong and you have to re-scramble, I'd need them to have a lower ITV on that, more safe.
No, I get it. I get it. And honestly, too, part of one of the things I wanted to share, if you guys recall, the back end profit is around $58,000. So one of the things you could do is by taking that acquisition fee on the front end, we could probably withhold some of that as basically retained earnings in the company or the trust or whatever. And if anything ever goes south with this investment, and we need to pursue a potential foreclosure or anything, we already have some money set aside to deal with these issues. And then also what we could be doing is a couple of things. We could either take more money on the front end and use some of that money to make interest payments to our investors to keep them
Right,
happy, or we could set the expectation at the beginning or the outset of the investment that if this was to go south and the borrower defaults and payments cease, then we will cease making payments to our investors, but that interest will continue to accrue. And
right.
if you have enough profit built into the deal on the back end, then it's going to eat away at that. So certainly when it does pay off or gets refied,
Yeah, so
then we
you
would just
kind
have
of
less
you
on the
do
back
have
end.
some padding there based on the profit that you have there, but you obviously you're willing to give that up to keep your investor whole, but you have some padding there to where you have some room, which is nice, you know.
Right, Right. So
to sort
guys,
of
investors are
not
golden. You want to keep them happy. You want to take care of your investors always.
exactly. All right. Well, fabulous, Anthony. Really appreciate it once again, and keep me posted if how this works out. I mean, it would be fun to come back around and say, hey, this is what really happened, or if not,
Yeah.
what snags did you have and what did you do? I mean, these are the things that to me are really valuable because I'm not doing exactly what you're doing, so that's why I love this community idea of, hey, what's everyone doing? How are you adapting based on your market? So it's awesome. So thanks again,
Awesome.
and we'll catch
Okay.
you next time.
Okay. You're
All
welcome.
right,
Talk to you guys soon. Take
take
care.
care. Bye bye.
Bye bye.